Hey everyone, welcome back to another episode of Stage Debate with Cossack Isaac. I'm Isaac Weinberger, Cossack Isaac. I help people just like you offset their tax liabilities utilizing cost segregation, accelerated depreciation. Another big part of what I do is help people just like you learn more about the real estate space by bringing on some big time guys and telling us about their journeys. Episode number 3 will be featuring 3 dynamic folks in the multifamily syndication space: Teddy Mohlman, Abadie, Glenn Gonzales. Today's topic is sourcing and closing deals. We all know how hard that can be. Come learn from the best. These guys have done it, and they have some pretty good advice. Big thank you to our sponsors. Our episode sponsor, AHS Construction, led by my very good friend Josh Freund, nationwide construction experts. You're buying a multifamily deal and plan on doing some value add, these are the guys to do it. Thank you very much to our corporate sponsor, Michael Stern of Line Star Tax and LST Consultants. Outsourced CFO services, a real tax genius. Thank you guys so much. Let's go. Welcome back, everybody, to another episode of Stage Debate with Cossack Isaac. We're joined today by some amazing folks in the real estate space. Glenn Gonzales of Obsidian Capital, Teddy Mohlman of Higher Ground Investment Group, and Abadie from Cove Investment Group. All tremendous guys in the real estate syndication space, have done tremendous amount of things, successful deals. People know them, and it's an honor to have you guys on. Thank you guys for joining.
Thanks.
No, thank you for having us.
Yeah, excited.
Absolutely. This is going to be exciting. Again, everybody, the idea of Stage Debate is we bring on a few successful guys and we really debate each other. We talk about different topics in the real estate space. Today's topic is going to be sourcing and closing deals. It's a topic at hand. It's not easy to close deals. It's not easy to source deals these days. And we're going to hear from some of the experts in the field. We're actually going to have the guests, the panelists introduce themselves. So Glenn, please take it away. Give us a little bit of a background of your journey in the space, just for a minute or two, and a recent deal you closed or a deal that you're currently working on.
Awesome. Thanks, Isaac. Appreciate that. Again, Glenn Gonzales, been in the industry about 30 years. My story is a little unique. I actually started off as a maintenance man, fixing apartments, and then I moved into the property management and was an on-site property manager of 60 units, I think. And so I got some management experience, and then graduated college from the University of Utah and decided to make property management my career. So I got a real estate license, broker license, got my CPM designation, and then just kind of moved up the ranks per se in property management. I was a regional manager for a while. Worked for some good companies like Equity Residential in the Pacific Northwest. Had a portfolio out there. And then moved over to the asset management side, on the ownership side, and was supervising property management. And then eventually owned my own property management company. And about call it about 11, 12 years ago, started syndicating, buying my own deals, and got up to about 6,000 units that we'd bought, and sold those units probably in 2018, 19, and 20, when cap rates were really low and people were overpaying. I was anxious to oversell. So kind of made my mark in the multifamily through the property management side. So.
Love it. And any specific deals you're working on now or anything you closed that you could give us a little insight on?
Yeah, so Mike's my business partner, by the way, Mike Woodfield. So he and I closed the Bridge Apartments. It's up just north of Austin where we sit in Temple, Texas. It's 232 units.
I did the cost seg on that.
What's that?
I said I did the cost seg on that one.
You did the cost seg on that. That's right. And Mike might have probably talked about it on your last episode. So. And then we have one under contract right now. It's 290 units. It's actually 2 properties that are very close to each other, same seller. We're buying them at the same time, so we've got a little blended returns. One's 200 units, the other one's 90. So we're raising one fund to close on both those transactions. It's a Freddie assumption. I think the interest rate on that is fixed for 8 more years or 9 more years at 3.65. So it's got some good solid cash flow. It is interest only for the next, 8 or 9 years. So we should have that one closed, I would say, in the next 30 to 40 days. So we just finished our raise. So
Super, super impressive,
Congrats.
Glenn. Super impressive. I am in on that a little bit, so but that's super exciting. Avi, can you give us a little bit of your background and some things that you're working on now?
Sure, sure. Quick background. I started my career in 2010, 2011 at a shop called Crown Acquisitions. They are a real estate acquisition firm focused on retail-oriented properties. I ended up leaving in 2012. I partnered with one of my very close friends, Mikey Mitnick. We started AMS Acquisitions in 2012, really to focus on mixed-use, multi-retail development and office in and around New York City. From that time, from 2012 to 2015, we spent most of our time buying deals in Brooklyn, Queens, Manhattan, and Connecticut. And at the end of 2015, we felt, New York kind of peaked and rates ticked up a bit, and we felt, we had to find areas we felt had a bigger trajectory for growth over the next few years. We ended up buying from 2015 or really 2016 on in downtown Yonkers and Bayonne, New Jersey. We bought a lot of land, multifamily, mixed use, retail properties as well, within maybe 5 block radius of the Metro North Station in Yonkers. We ended up buying in Bayonne as well, land, multifamily, retail as well. And we ended up developing also a age-restricted 55-plus asset in Sayreville, New Jersey. By 2019, rent laws changed. Personally, I felt the political climate in New York was very difficult for the real estate industry. Then COVID hit, and I ended up starting a new company focused on value-add, mid-market, multifamily assets in the Southeast, mainly focusing on select markets in the Carolinas and Florida. So we started that in 2021. I started with a different partner, his name Jeffrey Corkill, and Cove Investment Group started with that focus in basically the summer of 2021, really the height of the market. We ended up buying a couple of deals in Melbourne, Florida. We also closed a deal in Greenville, South Carolina. And our last deal to close was almost a year ago, actually, in Melbourne, Florida. And that was a 160 unit deal in Melbourne, 1985 vintage value add. Luckily, all our deals have fixed rate, no floaters right now, and low leverage across the portfolio.
Super cool. Avi, I've been watching your journey, and it's incredible. You're taking down some nice deals and not easy markets, especially in Florida with insurance rates. So it's impressive. Teddy, we all know you took down a nice deal recently. Give us a little bit of a background of what you've done in the space and how you got there, and fill us in a little bit.
Yeah, originally born and raised in Miami, Florida. I come from some sort of like a generational background of real estate. My grandfather had some successful businesses where he flooded most of that cash flow and money into real estate, majority of it overseas. That trickled down to my mom and eventually kind of trickled down to me. At the time, I started real estate about 6 or so years ago, but before that, I was actually in the food and beverage space for many years. I had a catering business at the time. I was also a private chef in Miami, Florida. So as you can imagine, working in incredible homes with very, very wealthy people. And when I had the time to discuss or briefly have a conversation with the owners of the properties, I always asked them what they did for work. And a lot of these guys sitting on $10+ million homes with a $5 million yacht in the back. They were all strictly in real estate. So decided to take a pivot and go into real estate since I knew that was probably where I wanted to be. And since then, I started smaller scale, small multi, single family fix and flip model. I also have a residential brokerage arm as well. But as that fix and flip model started to scale into larger and larger deals, obviously going into larger and larger multifamily, that's kind of where the syndication model kind of came from. As you guys most likely know, it's plus or minus the same amount of work to underwrite a 10 unit deal that it does to underwrite a 100 unit deal. You just need more money. So Opened up obviously into other investors, obviously the original, your sphere, friends and family, and then outside capital and family offices. And we've been scaling that specific arm for about the last 3 years in the syndication space. Right now we have a combination between co-GPs and lead sponsors, about 600 units to date. One of those was a larger acquisition we closed about 30 days ago, 360 units in Des Moines, Iowa, where we're heavily focused in right now. And happy to kind of discuss that a little bit in more detail as we kind of progress in this Zoom, given that we're discussing, sourcing and closing deals. So high level, that's what we're all about.
Okay, so that's super cool. I want to actually take off with you, Teddy. Fill us in a little bit. Obviously, there's many chapters in the book of sourcing and closing deals. Everybody has their sweet spot. I know that Glenn and Mike are focused on loan assumptions. Obviously, as a successful guy, you have brokers banging down your door. Which deals do you give a second glance at? Because obviously you're not going to start underwriting 200 deals a week. And there's a lot of deals. There's a lot of bad deals out there, right? So what's your process when you start at the beginning? Walk us through that for a bit.
Yeah, I mean, first of the two is just sourcing the deal, right? I mean, for me, I'm not the numbers guy in the business. My business partner is. He's the brains behind the scenes. He's the one that's underwriting deals, day in and day out. For us, broker relationships is very important. We treat our brokers, like friends and family. Whenever we're in town, we always take them out for dinner, meet them for drinks, whatever it may be. Very personal with them, checking in how they are once in a while. Even if we're not looking for deals, checking in with them once in a while, how their family's doing, etc. So broker relationships is really important. But like you stated, how are we kind of filtering through these deals? I think number one is, asking the right questions from those brokers. If you ask them a question point blank, sometimes they'll give you the answer you want to hear. For example, my number one right now is, are they actually a seller? Right? Or are they just looking for this crazy number that they get in 2020? And if they want to just see if something sticks, I'm not going to put that much time and effort into it. My business partner is not going to put that much time and effort to it. So I'd say number one is obviously trying to take that funnel of deals and really kind of filter it from the top, or else, like you said, you're going to be underwriting 200 deals. We have kind of a phase 1, 2, and 3 underwriting. Phase 1 underwriting is really black and white, very simple, data entry and seeing if we're anywhere close. If we're super far off, I'll have that conversation with the broker and say, hey, your broker wants 20 million, we're coming at 13. Is this guy a real seller? If yes or no, then we kind of go from there. If we're a little closer, we'll go into that phase 2 where we'll put a little more time and effort into it. And again, we're still seeing that gap, but if the seller is an actual seller and they're willing to actually work with us, we like to provide feedback within a reasonable time, because as Glenn and Avi might know, there's a lot of buyers out there bugging these brokers. And for us to not only get information from the broker, but actually provide feedback to them, show our underwriting, show why this deal doesn't make sense for us, why we think their number's off, and most likely it's off due to the seller trying to get a specific number, they actually remember us more, and they'll most likely send that feedback to the seller. So it just, again, it comes back down to that relationship thing. So for me, I think it's really just trying to filter out the non-sellers that are just trying to stick for that 2020 number that they're realistically not going to get. And then, again, try to provide as much information and feedback to the broker, because they really appreciate that when they send out, let's just say, 500 emails to 500 buyers that want deals, and only 1% of them are actually providing feedback. You really stand out.
No, those are great points, and you see over LinkedIn a lot these days. Take care of the brokers. Take care of the brokers. It's like a new trend, and I believe in that very much so, because you have a lot of active buyers, and you want the brokers to come to you first. Facts at the end of the day are that it's hard to find. I shouldn't say it's hard to find. You got to trust your broker, because you got to make sure that he's not just selling you the Brooklyn Bridge and they're not fudging any numbers. So it's important to trust them, and I'm a big believer in that. One thing I'll end off with you is, and then we'll hop over to Glenn for a second, we're very into brokers all the time. We go to conferences, we meet brokers, you take care of them, you take them out to eat. I have many friends that have found unbelievable deals through cold calling, off CoStar listings and stuff like that. And that's truly off market, because we all know, and we can laugh from today to tomorrow about off market. Oh, I found an off market deal. Off market deal. Everybody knows about that off market deal. When you cold call a guy and you find a family owned property that's been in the family for the past 30 years, that's Obviously, if that's in your market and that's what you're looking at, that's truly where it's at. Is that something that you guys have ever had success doing, or never found success doing that?
Well, I think for Mike and I, we've had more luck finding deals that the brokers actually have the listings on. I think Teddy mentioned earlier, you need to ask the broker, are these guys real sellers? Sometimes there's lots of people out there trying to get a listing by providing an offer. Like if I bring you an offer, will you sell the deal? So of course the broker is going to say I can get you 30 million. Things only worth 28 million. So they're like, yeah, you bring me a $30 million offer, and I'm a seller. And so so don't get used, too much underwriting deals that are going to just not produce. I think for Mike and I, our last few deals have all been through relationships, and having been in the business long enough, we've developed those relationships with the brokers where they know exactly what we're looking for. So you know, I, I haven't bought any Class A high end stuff, so the brokers that have those listings aren't calling me. But the ones that have assumable loans, or I've said, hey, look, if you can get me to the mid teens on an IRR and a solid, cash on cash that's anywhere north of 6 or 7% in year one, we'll look at those deals. And so we get those specific deals. Like they're coming to us and they're through people we've already closed with and already transacted with. So those brokers become our friends because they'll tell the sellers these guys will produce and they'll close on time. And fortunately, Mike
Yeah.
and I have not had to back out of any deals. So I think there was only one that we actually backed out of in our whole partnership time, and that's because the seller was the issue, not us. So
Yeah, and I'll piggyback on that really quickly, Glenn. It's kind of like you said, be specific on your buy box, on your criteria, because that will really eliminate some of those emails come through. And sometimes I'll call out a broker, in a nice tone, of course, where they send me deals in the A class, in the A class buy box. Where I've told them many times, hey, we don't do A class. We need value add. We need meat on the bone. And they continue to funnel me and call me about these deals. I tell them I don't want anymore. And it's like, hey, respectfully, this has been our fifth call. We don't want this. Like
yeah,
help yourself with this phone call. It's more in my inbox. It's more stuff that I got to go through, right? So really try to be specific with those brokers. And I hate to say it like this, but sometimes make it idiot proof and send them a nice clean email. Please only contact us for this specific buy box, so we can actually take your email into consideration. Versus if you're getting flooded with these A class deals with that are not cash flowing for us, and we need that value add. It's just eventually I'm just going to block that broker because it's too much going on. Too
yeah,
many emails coming through. Yeah.
yeah. I don't know about you, but I probably get anywhere from 10 to 15 new deals every single day. That's how many deals are hitting my inbox right now of opportunities. So there's really not a limit on the amount of opportunities that are out there.
How many of those
Um,
10, 15 deals, Glenn, are good deals that are actually in your buy box?
Probably zero. you know,
You got to
uh,
be like
it's
Teddy and tell
yeah,
these brokers you
yeah.
got to
The
stop,
ones
stop
that
flooding my
we're the
inbox.
ones that we're buying have come through relationships where like Mike probably talked about the one in Temple. I mean, those brokers we know very well. They're good friends. I've gone skiing with them, but they're like, look, Glenn, these guys don't want to waste time. They said we could put it in front of four potential buyers, and you're one of the four on the list. We're not going to blitz it out there. And I said, great, let's take a look. They're like, because it fits right in your wheelhouse. There, it's what you're looking for. And they were right. And so we bought it. It was 232 units, and we closed on it on time. And the same thing happened on the 290 units we have under contract that we're going to close here shortly. Same type of thing. It didn't go out to the whole world. It just went to a select few. So I don't
For
know. Those
sure.
relationships, Eddie mentioned it. So
Once those brokers know that you are an actual buyer and you can raise the money and you have the durability to get it done, obviously we all know that they're going to contact you on the next deal. Avi, let me ask you like this: your acquisition mindset and how you play things out. Maybe some red lines that are deal breakers for you after you're going under contract kind of deal. And I'm assuming throughout your history there has been stuff through the due diligence process that you've seen certain things, and just maybe walk us through that process.
We really like to do a majority of the due diligence before we really put hard money down, right? Or even soft contracts. That's that's really how it's been done in New York, and so that's where I kind of grew up buying deals. So in New York, there was no due diligence periods. It was really just trying to get as much information as you can before deciding to put down a hard deposit. But in terms of a buy box, pre-contract, our buy box has kind of changed over the last 2 years or so. We used to be 70s plus, now it's more 90s plus. We're also, just as Teddy mentioned, Glenn mentioned, one of the top questions is going to be, what's the story with the seller? That used to be maybe the second or third or fourth question. Now it's the first question. To me, did this guy, owner, did he buy it before 2020? Has he owned it for 5, 7, 8 years? Is he going to make money at today's market price? Or is he just fishing? Or does he have to save himself? And usually what I find is a lot of people, unfortunately, they hold their asset hoping and that things will get better, and end up kicking themselves that they should have sold it 6 months before, 9 months before, when they had, an offer of X. Now it's an offer of Y. It's just, I think a lot of people have everyone wants to be optimistic, but everyone thinks things will get better before they actually do. And so, but on a due diligence, in terms of due diligence, where would we try to kill a deal or have to kill a deal? I just speak only from recent experience. It was insurance. The insurance market kind of resets every January. Luckily in Florida, we owned a property that we closed on in January. So our renewal was coming up, and we were paying $700 a unit, which was pretty high then. Now all in, we were at close almost to $2,500 a unit.
Wow.
And we were under soft contract. Yeah, very painful. We were under soft contract for another property in the same market, and we probably had, I don't know, maybe a couple of weeks until we had to go hard, and when our renewal came in. So we underwrote $1,200 a unit or so on that deal, thinking we were being conservative.
Conservative, yeah.
Right, from 700 to 1,200, we're like, oh, it's almost double. That should be conservative. Yeah. Either way, we kind of got very alarmed. We started calling the insurance brokers, and we were trying to get a quote. And we basically told the seller we weren't going to go hard until we had a quote that we could actually bind. And we were working with the seller, and it ended up coming out to be like $2,200 or so, $2,400 a unit that we got quoted on. And we basically wrote a whole letter to the seller saying, we could only close at X price. I mean, we were under contract at 30.5. We needed a $2 million discount plus, and they were going back and forth. They were a larger fund. They were giving us a bit of trouble. And what we ended up doing was we dropped the contract, and they ended up blinking first. We felt that they had to sell anyway. And we ended up getting a $1.9 million reduction. But they said, if you want this price, you got to close in 30 days. So we called up the lender, which we hadn't continued the process because we didn't think we'd actually get the deal done or come to an agreement. And we ended up calling the bank that we had originally started with. And they're like, we could close in 30 days, and which is shocking. And we ended up lining up a bridge lender, just in case the bank couldn't come through, because the seller seemed very adamant about taking our deposit if we didn't go through on 30-day close.
Yeah. You know what, Avi, if you wouldn't have if you would have backed out of that contract and somebody else had the same or similar underwriting as you, that variable of $2,200 a door would always be there, right? So the sellers were going to have to face that issue,
correct,
with every potential buyer, right?
100%.
And so you did the right thing. You're like, here it is. I mean, this is the issue, and it's not really your issue or the seller's issue. It's just a fact of life in the environment we live in. So it kind of forces.
I also think you're fortunate. I think if I heard you correctly, you're working was a fund that was the owner of that apartment. Is that what I heard correctly?
A large group.
Well, they actually see it in the lens that Glenn just specified. Well, hey, we're going to go back on the drawing board. The next person's going to do the same thing. Versus some of those legacy ownership groups, they think, no way I'm getting a $2 million discount. I'll get a better number with someone else. Yeah.
But Teddy and Glenn, you know as well as I know that when the seller tells you, oh, listen, if you don't buy it, we're Well, we'll work the deal ourselves. We'll do the interiors, and we'll come back to the market in 2 years.
Yeah.
They could be
Yeah.
telling the truth. They cannot be telling the truth.
Hey, we
So
put
yeah,
an
Yeah.
offer
you
on
never
a
know.
deal, and these guys didn't accept our offer. Somebody else outbid us, and so they couldn't raise the equity. So the sellers came back to us and said, "Oh, our buyers backed out. Do you want to kind of match their offer?" And we gave them our offer where we could raise money. The problem is they had like a problem. I did the math they were at, and they would have to give their investors like a 3% return. So of course,
Mm.
no one's going to invest. So we said, no, we're going to stick to our initial offer. And they said, okay, well, we've got another group that's kind of above where you are. And we said, well, take that offer if it's more money. But, I mean, if they're going to have the same dilemma that your last ones are having, and that is that their price is too high and they're going to go try and raise money because they locked up a deal. But you could be right in the same boat you were, 2 months ago, 3 months ago. And guess what? They called us like on Friday last week after two separate buyers have backed down. They're like, are you guys still having interest? We're like, yeah, but our price just went down.
Correct.
Yeah.
Yes, exactly.
Treasury goes
Yes.
up,
know,
price goes
you're gonna
down.
play
That's
games
it.
with
That's
me.
right.
You're going to
So,
play
Yeah.
games with me. I'm going to play games back with you. Avi, I know there's something we have discussed before that many times these owners will be like, hey, you're not giving me what I want, and I'm going to go to market. I don't understand that because obviously you're going to have to start paying brokers all these fees, and who says you're going to get a guy? For example, I know, Avi, a specific situation with you, and I have another friend and client that had bought a property from a family, and they had another property that for sale, and they wanted a little more, and they went to market and they couldn't get what they wanted. And I just think if you getting a guy that knows how to close, and you're not going to have these dilemmas like Glenn mentioned. Obviously, money's important, but closing is important also, and it's going to stay on market for the next 6 months. By the way, we all know that when a deal is just shopped around, people lose appetite when it's just on the market for a very, very long time, unless obviously you get some huge price break at the end. Teddy, let me ask you something. Some red lines when you go under contract on a deal. Obviously, you're not just going under contract without underwriting it first and looking into it and doing some sort of level of due diligence. What are some red lines that maybe in the past have made you kill a deal?
Yeah. Yeah. I mean, I would say, we typically write offers or LOIs, once we're in deep, phase two underwriting. At that point, we are relatively on par with our numbers, obviously, that we can control. We do get typically quotes from our insurance brokers in, obviously, take that with a grain of salt these days, but we are relatively close with our numbers once we kind of go into the under contract phase. Obviously, post that we do a heavy due diligence. We walk all the units, we do our inspections, etc. And there might be some sellers that let's just say don't disclose things that they should have. And I would say, from my lens, the deal that we've terminated that has been strictly because of items that were not disclosed were material defects of the property that end up being very costly. I can give you one example: a deal in Columbus, Ohio, West Bexley Apartments. We were the third buyer that went in there, from what we were told, and no issues to report per the seller. Of course, we do our walkthrough. The entire 30,000 square foot commercial space was infested with mold. Three out of the five elevators were down and told me that they were just going to be, they did a pass inspection, they would be fine. But of course, the three out of the five were nowhere near inspections. The cables were actually cut. There was no actual elevator inside the shaft. So that was about a 270,000 per elevator. Seller's feedback to that was, well, you have two that are functional. You don't need all five. Little did he know, per code, you need to have X amount of elevators for X amount of tenants. And when we talked to the property manager, he told us that, I guess the seller at the time told us that he had no idea about the mold. We talked to the property manager directly. It looks like they were bumping heads. And she had informed us that he had asked her to paint over the mold many, many times over the course of the last 2 years. So, and then it being a position where not only were we finding out these issues, but it was just too many shady things happening behind the scenes where it's like, all right, well, this is what we know today. What are we not going to know post close? So I think after a thorough inspection, we decided to pull the plug, even though the deal technically penciled out, even with the price change or the retrade that we had to submit, given the mold remediation costs and the elevators. There was just kind of like that bad taste in my mouth at the point where I just didn't feel like anything that he said was honest, and I didn't want to set myself up for failure given that he was pretty shady since day one.
That makes a lot of sense. Glenn, question. So you guys are very, very hyper focused on loan assumptions. Loan assumptions are great, obviously, with interest rates being crazy. There's an argument to be made, and we've talked about this in previous episodes, that when you're buying a loan assumption, generally you're paying a premium. What's your rebuttal to that?
My rebuttal? Probably accurate.
But it's still
You
worth
know,
it.
I mean, yeah, probably accurate. You know, when you get a fixed interest rate at a low interest rate, and when I say low, in the threes, you know, you can really calculate out what your returns are going to be. It's fixed. It's people in this environment love the fact that you're not overpaying an interest. So yeah, you might pay a little bit of a premium for that building, and we probably would and probably continue to do so. I would say the flip side of that is our investors like the fact that a lot of the money is not going to the bank, it's going to them, right? They get a bigger chunk of the return. The yield is just there, especially if you got a great going in cap rate. You got that nice spread between your going in cap rate and that interest rate. So it's you know, it's probably a true. I'm not going to debate that too bad because I'll probably lose that debate. And since this show's all about debates, I want to pick one I might win. You know,
Well,
you
like
know,
you said, you're either going to overpay for the interest or you're going to overpay for the asset. It's one or the other. As long as
yeah,
the
yeah,
cash flows that hits those
yeah.
returns, you're
Yeah,
better off.
but
Yeah.
Mike and I will buy deals where we'll go get new financing, but we're just not going to pay the premium. Like Isaac said, you know, we'll buy it at a discount. You know, and I'll just tell you this right now: we are selling a deal in Fort Worth that has an assumable loan on it with Fannie, but the brokers suggested that, you know, the people would have to come up with a lot of money, you know, to get the leverage, you know, where it needed to be on our sales price. He gave us a broker price opinion about a year and a half ago, 2 years ago, and when he gave us, even though our rents are a little higher and occupancy is a little higher, the value came in less. But I didn't argue with him. You know, I wasn't stuck on that previous value because I know, like Avi said and Teddy said, the insurance costs are up. You know, cap rates are up a little bit, and then the interest rates are up. So it's like if you got a realistic expectation, you'll sell your deals too, and somebody will buy it. So.
Super cool. And Teddy and Avi, is that something you guys are looking into at all, or you guys stay away from loan assumptions?
It's a great question. You know, I actually looked at one of my first deals with a loan assumption because Glenn, I do feel that when you take a loan assumption type deal, you're paying yesterday's price, and it you know, where I was brought up in terms of the real estate and real estate education, it's like buying a triple net lease deal. You know, the guy's paying 30 a foot because the building was built for him. You know, a nice Walgreens or CVS. Mm-hmm. But if they went out, the market's like $8 a foot.
Yeah.
Right. So you're really buying that lease as opposed to buying the real estate. But that doesn't mean I write off all loan assumptions. You know, I actually looked at a loan assumption deal that was pretty interesting to me. It was a HUD loan. It's about 30 years left. It was amortizing, and the rate was 3.45. And I think usually the problem, I haven't done a HUD loan yet, but usually the problem with HUD loans are the hefty prepays. But it was already 5 years in, so you had a 5-year step down, a 5, 4, 3, 2, 1, which is, you know, better than a lot of deals today. Yeah. So it was interesting to me. It was also low leverage. It was at 60% and it was amortizing. So to me, that kind of offsets, and you almost had 200 basis points of positive leverage, which is also impossible to find now if you're finding a deal without an assumption.
Yeah.
And you know and it was a 2019 asset. Also, it wasn't coastal. It was in Florida, not coastal, and so it was interesting to me because it had also about almost 6.5% cash on cash going in. It wasn't a big value add, so you know maybe had some growth, maybe able to push $30, $50, $80, but you know if the market grew, that area would pick up, or those rents would pick up, and so would your return. Yeah. So I looked at one that looked like that because it was at 60%. Now, if it was a little bit higher, or I would see myself having trouble refinancing out, if God forbid the rates didn't go back down and they stayed, you know, somewhere in the upper 5s, maybe 6, would I have an issue? That's how I usually would measure whether or not those types of deals are worth looking
at. I think when you do an assumption, you really got to really dive into, the opportunity that's in front of you, because you're right. Sometimes these assumptions have already been underwritten, they've already been lent on at a certain value, and now we are kind of buying, what do you call it, last year's value or whatever. But the guy that we bought it from up there, he hadn't introduced any washer dryers into the units. They all had hookups, but we're now purchasing those. We're putting there getting $70 a unit for that. We've introduced, and Mike might have talked about this as well. The cable income. We got a bulk cable that we resell back to the tenants, and we're making a nice spread there. And then just the rents alone, they had such poor customer service, and they had so many bad reviews that now you move in and they have a good experience. Our renewals are renewing at $150 with doing nothing to the unit, but our market and asking rate are about $250 more. And it's just, we just put just some minor repairs in the building, so there was lots of opportunities. So we didn't mind paying up for the property because we knew that it was grossly mismanaged, and we could just score in several different areas. So
In a value add opportunity.
yeah, it was a value add.
Right.
Yeah.
That's very. That's
But we
very
didn't have to
important.
do a lot of heavy lifting, right? We did the parking lots and foundations, and we just fixed all the things that were broken on the exterior air conditioning units and stuff. So
Glenn, I
yeah,
really like that. I really like that point because, and it's actually something I was going to bring up. Somebody, and Mike had talked about this in a previous episode, that somebody who has these great ideas how to boost NOI, you might be paying a premium for the loan assumption deal, but at the same time, you're really balancing it out with these additional creative ideas that you may have, as opposed to somebody else. He's much more of a straight shooter. I need this deal at this and this price point, has to pencil exactly the way I thought before, as opposed to being more creative, paying a premium here and really balancing it out there. Teddy, what is your take on just general loan assumptions? Is it something you're staying away from?
Yeah, we've seen some chronic calls for desk. We closed one in May of, I guess in May. That one was a Fannie. It was in the threes. Leverage was in the right spot. I think we ended up putting about, yeah, I think it was 70% loan to value, so 30% down. So when it comes to that, I mean, it's really understanding kind of what does the term sheet look like, of course. What does the leverage look like in the property? Like if there was an interest only, are we going at 50%, 50% leverage? Then that kills our cash on cash returns, right? So really just kind of looking at that deal. Yeah, loan assumption might be great if it's in the high twos or low threes. However, there's a lot of variables to make it still a go for us. And like I said, leverage is a big one. I think it's calmed down now, and maybe Glenn can probably attest to this a little bit more. But timeline to close for some of those assumptions were 6 months plus. The one that we closed took about 7 months at no fault of our own. It was strictly they were backed up, given all the loan assumptions. We were also working with a terrible servicer called Sabal. Don't recommend them. So I think there's just many variables there. And then speaking with Avi is just in terms of the refinance, right? I mean, let's just say there's great killer debt on it, but maybe in 3 years it's about to expire. Well, with your crystal ball, what does 3 years look like in a refinance position, and making sure you set yourself up for success there, given you might be potentially paying a little bit more for that loan or for those interest rates, for example. But if the rates don't trickle down as much as people think they are, and personally, from my experience, I don't think they're going to trend down as significantly as people think. I do think we're going to see a little bit of a downturn given election year, and obviously, Mr. Biden wants to get reelected. They're going to try to trim that down a little bit, but I think there's also a soft spot where we don't mess up what we've done so far to keep that inflation data down. So I think the interest rates, in my opinion, aren't going to go down as much as people think. So there's a lot of variables for that, but for me, loan to value and then timeline to close is really important. And then the third piece of that is just really structuring the deal for success in the event that you do need to refi or sell the property as well.
It's really a tremendous point. People don't view it this way, but technically, if you buy a deal with a loan assumption that's expiring in a few years, you're really bridging it. That's really what you're doing. You're taking out a bridge loan, and the same people that are against bridge loans should be against these. Obviously, there's different details and nuances, but the point is that you're going to have the people that want to go ahead and take a deal at fixed debt and make their deal pencil with the 7-8% interest rate. I had a client that came to me last year, and he was like at 9.5, and I was blown away then. I was like, what? It didn't make sense. And he structured it in a way that it penciled, and obviously the win is his if rates go down, and he could refi at a much lower rate.
Yeah.
So really, really true. Okay, let's wrap this up, guys. This has been incredible. You guys all had some great points. I've gained from different things that you guys have said. For anybody that's listening to this, Glenn, Avi, Teddy, these are not guys that I have to sell. These guys, you could check them up. Check out the deals that they've done. Interested in investing, definitely get a hold of them. Before we do end, I want to go through each and every one of you, maybe for a minute or two, just to give a newbie a piece of advice. There's always a new generation, something that you would think would be beneficial for them to hear. And maybe also, just for a minute, an aha moment in your career that really like tipped the scale to push you forward. Let's start with Avi.
Sure. So I think a little bit of, I guess, some advice or a little tidbit. I think, first of all, disclaimer, I think we always continue to learn, right? We always face new challenges. We're always getting educated in this business. But what I would say is, now is an interesting time. It's been 2 years or almost 2 years since they started raising rates, and the market, volume has just collapsed. And, I speak to a lot of young guys. I speak to even people my own age, maybe even some older, younger especially. But the idea is, when the market's down, personally, I feel it's the best time to get involved, to get into the market. The train is not moving 150 miles an hour. And I have experience, getting into the market when it is going 150 miles an hour. And now is the time where the brokers will answer your phone calls. You could go meet people. They'll have a coffee with you. People have a little bit more time. Well, some people have a little bit more time to kind of answer your questions and network with, and also to learn the business. You don't want to be learning when it's going 150 miles an hour, especially as starting off. And it doesn't have to be your first year in real estate. It could be a new asset type, a new asset class. It could be a new job, a new position, a new company, etc. So I think hang in there. The more you plant now, the more you'll receive as the market comes back. I guess an aha moment for me was really in 2019, really before COVID, and it's more about politics. But the idea basically is, in New York, I felt that real estate became the industry with the bullseye on it, and the New York politicians, unfortunately, were really biting the hand that feeds them when it comes to their budget, real estate taxes, and when you basically try to make real estate difficult for a lot of people in the industry, then for me, I felt I had to move somewhere else, and COVID kind of accelerated that and pushed me down towards the southeast. But I think the biggest catalyst for me about being in New York and having to look elsewhere was when Amazon couldn't get a deal done in New York. I'm born and raised here, very personally pro-business, obviously pro-real estate, but the idea is, when 25,000 jobs get shut down in an area, especially of New York, that could have tremendously benefited from that, times have changed. It's no longer Bloomberg's New York. It's no longer Giuliani's New York. And I felt that, it's not, I don't like to go to sleep, basically not being able to sleep because there might be some legislation that'll totally destroy my business. So that was a moment for me that I felt, I'm going to have to shift soon. And then COVID came, and I think that, really made that go quicker.
Cool. Teddy, aha moment and some advice to newbie investor.
Yeah, I guess I'll start with the aha moment. For me, it's you have to be the teacher, you have to be the educator in the space, in my opinion. And the reason why I say that, so many people are listening to the news, they're watching, they're listening to the media, and they are there to sell you fear, right? Looking at the data is the most important thing, and if you can teach that to your investors, teach that to your peers, teach that to people that you're currently working with, I think that's going to be super, super important. So I would just say, be the teacher, really educate yourself. Like Avi said, that's super important. But not only educate yourself, but also be able to educate others with that. I brought a lot of investors that were on the sidelines for years. 2019, bubble's going to burst. Where we're at now, 2023, 2024, bubble's still going to burst. So I brought a lot of people off the sidelines then because, again, try to educate them with the data versus telling them to turn off the media for once and really try to show them that. So that'd be my aha moment. In terms of the newbies, you just have to take action. They say knowledge is power. That's total BS in my book. Knowledge is potential power. We all know how to have a six pack and muscles, but do we do it? No, because we don't actually want to eat healthy. So I always say take action. You have to build the plane while you're already flying. I'm not saying to get yourself in a bad position, but for you to take down a deal, you're not going to know everything. And if you want to wait till you know everything, you're never going to get it done. So build a plane while you're already flying. The law of the first deal is super, super important. Once you do that first deal, it'll snowball after that. Number two, I'll say hire a mentor or bring on someone within your general partnership piece and give them some equity in the deal to help them kind of navigate through all the hurdles and things that you might be learning along the way. And the third thing for me, I would say, is just build a team that complements your weaknesses. You don't want two really savvy underwriters on your team. For example, if you give me numbers, I can do it, but I'm not great. You give my partner numbers, he'll sit in a spreadsheet or an office of the spreadsheet for 2 hours and come back to exactly what I want to see. I'm good on operations, renovations, and more asset management. He hates doing that part. So try to find someone that's going to complement your weakness. So when something comes at you and an obstacle comes at you, you can both hit it from different angles.
That piece of advice is something that I preach all day, every day. You have two guys that are like, hey, we're so similar. We're both great networkers. We'll find deals. Those are the guys that they may be successful, but you got to get a guy that's going to complement you. The great underwriter, the great office guy, and you're the networker. So great points, Teddy and Abby. Thank you. Glenn, last but not least, just an aha moment in your long career and just some advice to the new guys.
Yeah, I think I'll start with the advice first. One is be likable. People in this industry want to do business with people they like to do business with. So be likable. And the other piece of advice is always do the right thing. There's a lot of people in our industry that may live in the areas that are shades of gray. For Mike and I, we're all about just do the right thing. I'll give you an example. We were selling a piece of real estate up in Fort Worth, and about 3 days before closing, the seller, or the buyer, we were the seller. The buyer had already non-refundable earnest money. They were getting ready to close. Our chiller broke. It just was at the end of its life cycle, and there was no repairing it. So we had two choices. We could stick a Band-Aid on it and let the buyer just deal with it, or we could buy that guy a new chiller, which is what we opted to do. And it was expensive. We called the broker, and I said, here's what happened. And he's like, great, because this is the kind of thing that kills deals, like right before closing and triggers lawsuits. And because, just all kinds of, but we just bought him a new one. It couldn't be installed in time for closing because it was 3 days later, but we put a 50% down payment and we put the other 50% in escrow with the title company so that it was covered. And now fast forward, I was at a conference about a year later, and we were introducing each other in a small group, a mastermind of probably 20, 25 people. And some guy across the room was introducing himself because I don't want to introduce myself. I want to introduce that guy over there. And he pointed right at me. And I'm thinking, do I know this guy? Who is that? And he's like, I've never met him before, but I know his name because here's what he did. He bought me a chiller on my property before it closed. And so if you're going to stay in this industry for a while, and these newbies that are coming up, just do the right thing and be likable, and you'll be successful because the deals will find you. A lot of people have asked me over the years, how did you get started? And I shared that story with a bunch of others, but they're like, oh, you need to write a book. So guess what I did? Maintenance Man to Millionaire. I wrote a book.
There you go.
So it's got a bunch of those kinds of stories in there that just talk about the successes and a lot of my failures, the aha moments, as you might say, because they stick with you the most is your mistakes. So that's what I have.
Super cool. So Glenn wrote a book, everybody. So all the listeners, check it out. Glenn, what's it called again?
It's called Maintenance Man to Millionaire, and it is on Amazon. So
you can buy it on Amazon. Wow.
Yeah,
okay,
yeah.
I know what I'll be putting in my cart tonight.
Yeah.
Wow. Listen, one thing I will say is, and I think this is so true, and it's something that I try to live by day in, day out. As a sales guy myself, there's so much opportunity to mislead a client. There's so much opportunity to be dishonest and potentially win more business doing that. And I have the challenge all the time. What should I do? And thank God it's the way I was brought up and it's the people that I surround myself with. I've opted, like you, to really choose to be honest. And when somebody's honest, we all know this, it will never come back to bite you. It'll only you'll be known in the industry as that honest guy. You might win more business right away, but ultimately it'll come back to bite you that this guy's a dishonest guy. So I appreciate that. You guys were awesome. This is incredible. Thank you so much for coming on. Hey everyone, thank you so much for tuning in to another episode of Stage Debate, the only podcast that is panel style. Drop a like, drop a follow, subscribe. You can find us on Apple Podcasts, Spotify, and YouTube. Thanks for tuning in. Have a wonderful day.